A week ago, I made a video arguing that the entire stock market had split in half over one question. The AI boom is real, but who pays for it and can they keep paying? I want to show you what just happened because the market didn't wait long to start answering. And the answer is stranger and more revealing than either side predicted. Here's the setup. Meta, one of the biggest spenders in the entire AI race, is on track to spend somewhere around 130 to 145 billion dollars this year in AI infrastructure. That's not a typo. One company, 1 year, over $100 billion on data centers and chips. And last week, news broke that Meta is building a business to sell its excess computing power. Read that again, excess. Meta built so much AI capacity that it has more than it can use itself. And now it's going to rent the leftovers out to other companies. Now, here's the part that should make you sit up. When the news hit, Meta's stock jumped. It jumped up as much as 10%, but at almost the exact same time, a whole set of other companies got crushed. Chip makers fell. Two companies whose entire business is renting out AI computing power dropped 12% in a single day. One well-known analyst called it, in plain words, the AI bubble bursting. So the same event, Meta admitting it overbuilt, sent one stock up 10% and sent others down 12. Same news, opposite reactions. That contradiction is the most important thing happening in markets right now, and by the end of this video, you're going to understand exactly what it means. Here's what I'm going to give you. First, why one company admitting it wasted money made its own stock go up, which makes no intuitive sense until you see the logic. Second, why that same admission terrified a specific slice of the market. And third, the part that actually matters for how you think. A framework for reading moments like this, where the reaction to news tells you far more than the news itself. Because that's the real skill. Anyone could read a headline. The professional edge is in reading how the market responds to the headline, because the response reveals what the market is actually afraid of. I'm Daniel Ayala. I manage a fund professionally every day, and most of what I do is exactly this. Not predicting the news, but reading what the market's reaction to the news is quietly telling you. Let's get into it. Quick thing first. If you watched my video last week about the market splitting over AI spending, and you're now watching that exact question start to resolve in real time, drop the word resolving in the comments. I want to see how many of you are following the story as it develops, because we're watching a thesis play out live, and that's rare. Let's start with the strangest part. Meta essentially admitted it built more AI infrastructure than it needs. Normally, a company admitting it overspent by tens of billions of dollars would get punished. Instead, the stock rose. Why? Here's the logic. And it's the key that unlocks everything. For months, investors had been nervous about Meta spending. The worry was simple. Meta is pouring $100+ billion into AI, and nobody could see how that spending turns into revenue. It looked like a giant cost with no clear payoff. Money going out with the return being a question mark. Then Meta says, we're going to sell our excess capacity to other companies, and suddenly in investors' minds, that giant cost transforms into a potential revenue stream. The same $100 billion that looked like a scary expense now looks like the foundation of a new business, like renting out rooms in a mansion you already built. The building didn't change, the story about the building changed. It went from reckless spending to infrastructure we can monetize. That's why the stock went up, not because anything about the spending changed, but because investors were handed a way to see the spending as an asset instead of a liability. The numbers stayed the same, the interpretation flipped. And I want you to notice something, because this is the whole genre of what I teach. The interpretation is the thing that moved the money. Same 100 billion, same data centers. The only thing that changed was the frame, and the frame was worth tens of billions in market value. If you ever doubted that interpretation matters more than raw facts in markets, here's your proof. Now the other half. The same announcement that lifted Meta crushed a specific group of companies. The chip makers, and especially the companies whose entire business is renting out AI computing power to others. Those rent you compute companies dropped 12% in a day. Why would Meta's good news be their catastrophe? Think it through with the framework from last week. Follow the money one step past the headline. If Meta now has excess computing power it's going to rent out, that means two things. One, Meta might stop buying as many new chips because it already has more than enough. Bad news for chip makers. And two, Meta is about to become a competitor in the business of renting out computing power. Directly bad news for the companies that do only that. A brand new, deep-pocketed rival just walked into their market, but there's a deeper fear underneath, and this is the one that actually moved the market. If the single biggest spender in AI is admitting it built too much, that everyone spent too much too fast, and the demand may not be there to fill all that capacity. That's why one analyst called it the bubble bursting. Meta didn't just report on Meta. Meta gave the market a data point suggesting the whole AI build out might be ahead of real demand. So the chip makers and the compute rental companies didn't fall because of what Meta did. They fell because of what Meta's admission implied about everyone. The market took one company's "we overbuilt" and asked how many others overbuilt too. Now here's the tell. The thing that reveals what the market is actually afraid of. Watch which companies rose and which fell, because the pattern is precise. The company that can sell compute, Meta, went up. The companies that only supply the parts or rent out raw capacity went down. The market drew a very sharp line. Reward the players who can turn AI spending into revenue, punish the players who are just costs in someone else's build out. That's the answer to the question I asked last week, arriving in real time. Remember, the question was, who pays for AI and can they sustain it? The market is now answering. The winners will be the ones who can turn the spending into income faster than the next company. The losers will be the ones who are simply a line item in someone else's budget. One strategist put it exactly this way. The market has stopped rewarding the act of spending and started asking whether you can turn that spending into revenue faster than the next guy. This is a profound shift, and it happened in about a week. For 2 years, the market rewarded any company that spent big on AI. Spending itself was the bull signal. Now, spending alone gets you punished, and only monetization gets you rewarded. The rules of the game changed, and the change is visible in exactly which stocks went up and which went down on the same day. So here's the framework I want you to take. When a single piece of news makes some stocks rise and others fall, don't ask, was the news good or bad? Ask these 3 questions. These questions are what I run when a headline splits the market. Question 1, what frame changed? Meta spending didn't change. The frame around it flipped from cost to revenue. Always ask what story about the facts just changed, because in markets, the story often moves the money more than the facts do. Facts are usually known. Frames are what get repriced. Question 2, who's on each side of this? When news breaks, sort the players into who benefits and who's threatened. Meta benefits. It can monetize. The chip suppliers and compute renters are threatened. They're now competing with a giant or losing a customer. The pattern of winners and losers tells you what the market is actually rewarding and punishing right now. Question 3, what does the reaction reveal that the news alone doesn't? The news was Meta will sell excess compute. The reaction revealed that the market is now terrified of overbuilding and has switched to rewarding monetization over spending. The reaction is the real information. Anyone could read the headline. The skill is reading what the market's response tells you about its deepest current fear. And here's where I stay honest with you. The way I always try to. I'm not telling you whether this is the top of the AI trade or just a healthy shakeout. I genuinely don't know, and neither does anyone confidently claiming otherwise on your feed this week. It's entirely possible this is the beginning of a painful repricing of overbuilt AI infrastructure. It's also entirely possible this is the market maturing, getting more discerning, rewarding real business models over blind spending, which would be healthy, not catastrophic. Both are live. What I can tell you is what to watch, because the framework points you there. Watch whether more big companies start admitting they overbuilt. If Meta is the first of many, that's the overbuilding story confirming. Watch whether the AI spenders start showing real revenue from all that infrastructure. If they do, the monetization story wins. And watch that sharp line market drew this week. As long as it keeps rewarding the companies that turn spending into income and punishing the ones that are pure cost, you know exactly what game is being played. You don't need to predict which way it breaks. You need to know what question the market is asking. Can you monetize, or are you just a cost? And watch the evidence come in with a clear head, while everyone around you is screaming bubble or buy the dip, with equal certainty and equal blindness. The people who navigate this well over the next few months won't be the ones who guessed right. They'll be the ones who understood what was actually being decided and stayed calm enough to watch it get decided. If this way of thinking is useful to you, I write a free weekly note where I do exactly this. I take whatever the market is wrestling with that week, find the real question underneath the noise, and give you a clear-headed way to watch it play out. No predictions, no hype, no bubble or boom theater. Just the framework applied to what's actually happening. Link is in the description if you're interested. And I'll leave you with the 4th question, the hardest honest one, the one I hold myself to every week. What would change my mind if you decide right now that this is a bubble? What evidence would make you admit you were wrong? If you decide it's just a dip, same question. The ability to hold a view and know what would overturn it, that's the whole game. Come practice it with me. If this helped you see this week more clearly, share it with someone who's only heard the bubble and buy the dip shouting. There's not enough calm, structured thinking out there, and the more of us who do it, the better the whole conversation gets. I'm Daniel Ayala. Thanks for watching, and I'll see you on the next one.